taxes are one of the biggest expense that we experience over our lives, and a lot of people choose to build businesses in order to help mitigate the amount of taxes that they pay over their life, as well as create freedom for themselves through, building a revenue stream outside of like a normal W-2 job. And quite honestly, that's why a lot of people get into the game of building a business, is they're just trying to build a life that they actually want to live. And in this video, I wanted to talk a little bit about some of the things that I wish I had known, specifically about taxes and how to think through the different levels of your taxes as your revenue grows in your business. Obviously, building a business is hard enough as it is, but if you don't understand how the game is played, you're ultimately going to be paying a lot more taxes. And there are certain things that need to be done in order to minimize the amount of taxes that you're ultimately paying to the government. And at the end of the day, our goal is to figure out, how do we pay what is the fair amount that we need to pay, so that we can continue to invest into our business and grow what we're doing, create jobs and things like that. So in this video, I want to talk about specifically kind of the three different stages that you go through when building your business, and how to think through, where do I need to start to add in team members. Now, I do have to preface, I'm not a financial advisor. Don't take this, this is for educational, informational purposes only, and based on my experience. And I just kind of wanted to kind of walk you through my experience, so that way you can hopefully know when it's appropriate to go and seek advice, because quite frankly, a lot of times we get into business and we're just trying to scrap and put everything together, and we don't necessarily have trusted advisors that we can go to from the get-go. And knowing what you're looking for can be super helpful. So that's what I want to do in today's video. So I've drawn up a couple of different stages that we have. So we've got this 0 to 1K a month stage, which I would call kind of like the startup phase. And then you've got the 1 to 3K a month stage, where it's like your business is starting to show signs that it can go above and beyond just being kind of like, a decent income. And then once you get to 3.5K and beyond, that is when the structure of your business really needs to change in order to minimize your overall tax burden. So as a sole proprietor in that 0 to 1 stage, you're basically, everything is like treated as a pass-through entity. This is where you want to make sure that you've got a separate bank account and separate credit card, where everything associated with the business is running through that stuff. It's still going to be like a personal account, but it will primarily, you want all transactions to happen through this separate account, because you're trying to simplify the process so that when you actually go to file your taxes in April, you can pay the amount of tax that's appropriate, and kind of basically take your deductions as you see fit. Usually for 0 to 1K a month, at most you're talking about $12,000 worth of revenue. Obviously, when you take out your expenses, net profit will probably be less than 10K, unless you're just doing like a service-based business where there's no like cost of goods. Usually around the 1 to 3K mark is where it's appropriate to go ahead and form a separate entity. You're doing enough revenue where you want to make sure to protect your own personal liability, and setting up a single member LLC in your state generally is a good practice to go through. This is about the time where it makes sense to start having conversations with a CPA. Now, at least in my experience, when you start talking with a CPA, obviously this is going to add like an overhead cost that you're probably not ready. Like, it's going to be a tough pill to swallow, because at the end of the day, you're trying to build your business, you're trying to put money essentially into your pocket, and now you have this additional expense that is more of a protective expense, where your goal with that expense is to hopefully save a little bit of additional money through some strategy and that kind of stuff, where they can give you some ideas of how to save additional tax, where the amount that you're paying them is less than the value that they're providing, just from a strategic perspective. Once you get to $3,500 a month, we were talking around $40,000 a year. This is about the time where it makes sense to go from a single member LLC, which is usually structured as like a sole proprietor, to what is known as an S corporation. And by doing this, we change how we can pay ourselves. So normally, when you're just a sole proprietor in the 0 to 1, all revenue taxes or revenue expenses is done on the personal side. Once you've evolved and you have your LLC, now you've set up separate business accounts and credit cards associated with the business. So revenue comes into the business, and then you pay yourself on the personal side, whether that be at the end of the year, every month, whatever. The caveat by this structure is you also have to deal with what's known as self-employment tax. So a lot of times, so take whatever tax bracket that you find yourself in, whether you have W-2 income or that kind of thing, and basically you tack on an additional, I think basically it boils down to like you get taxed at around a 50% rate. So basically after everything is said and done, you have the money coming in, you have expenses associated with that, and then you only get to keep half of what you made. So this is why when you now move into this $3,500 a month, you now have the ability to tax yourself as an S corp. Now, the reason why you wait until you're at $40K a month is simply because there's some additional expenses and things that need to be accounted for at this point in time. You now have to use a payroll service to pay yourself, whether that be biweekly, monthly, whatever. And that payroll service has to then take out your Social Security, Medicare, Medicaid, state and local taxes, and all of those details. There's additional filings that are required. There's a bunch of additional overhead. However, while that additional overhead, like when you are looking at it you're still paying roughly 50% in tax on the money that's coming through that way, but you now have the opportunity to not only pay yourself through a salary, so we'll just say salary, you now have the opportunity to also pay yourself what is known as a distribution. And basically, so in the IRS guidelines, they talk about paying yourself a reasonable salary. And this is going to be highly dependent on like what industry you're in, what type of business that you have, and that type of thing. For me, I'm in kind of the social media land, and because of that, I can pay myself $40K a year, no big deal. And from this, basically all of the Medicare, Medicaid, those type of taxes get taken out of that, and then any profit above and beyond that $40K. So we've got 100% of the revenue coming into here. This is some percentage. I think right now, I'd have to do the math. This is some percentage here of like the total amount coming in. After all expenses, including the salary, is taken out, anything that's left over in the business can now be distributed to myself, and it avoids having to pay that self-employment tax. So basically, the only tax that's required to be paid on that is federal and state taxes associated with that, because it's treated as like a dividend. So it's still active income because you own the business. And actually, I might be incorrect in that. It might not just it's treated as a distribution, so it might not technically be considered. At the end of the day, it's taxed at an ordinary income level is I think the appropriate way to say it. But what that does is that minimizes none of that money goes through the normal self-employment tax. So it avoids Social Security, Medicare, Medicaid, and all of those additional taxes, which usually comes out to be about, I think it's 15.4%. So if you've got, let's say, at the end of the day, you've got $100,000 over here, and you're paying yourself 40. So you minus the 40, and you've got 60 left over. So if you were ultimately so 60K is coming to you personally in a distribution, and let me just run some quick numbers here. So 15.4% of that is what? 15.4% of 60K is around $9,240 worth of tax that you saved. So simply by hitting a point. Obviously, as the amount of distribution goes down, this number is going to scale down. But at this point, we're basically able to scale back the amount of taxes that we're ultimately paying and can more efficiently take money from our business and put it into our pocket in order to grow what we're doing either on the investment side and things like that. So these are kind of the layers that you need to think through. Typically, like I said, at stage 2, you're talking with a CPA. You can generally get by with the reason why I recommend having a CPA at that stage is just to make sure that you're deducting all of the things that you have. You're doing the home office deduction and those type of things in order to maximize the amount, minimize the amount of taxes that you're paying in that second stage. But it's not really until the third stage that you get to the point where you really can crank up the savings simply just by changing a couple of minor things from a structure standpoint. Obviously, it takes time and effort to set up the things that need to be set up in order to have be structured as an S corp. And there's some additional filings that need to happen, like on a quarterly basis, that will get taken care of through the payroll service. So that additional expense, and like I said, that's why 40K is kind of like the break-even point where it makes sense to start to move in that direction, just because there's a fine balance of like time and effort and the amount that you're ultimately going to save. Ideally, I think the more you ultimately make within your business and profit from in your business, that is ultimately going to dictate your total savings. But this at least gives you kind of a general idea of when you need to start considering having those conversations with a CPA or more of a tax strategist, because they're going to be able to help guide you in the direction of here are the things that you need to do in order to maximize the amount that you get to keep into your pocket versus having to give over to the government to spend however they see fit. And as we all know, the government is less efficient at spending resources than you are. So you might as well get to keep as much as you can in order to, invest in your business, invest in things that matter to you rather than them. So I hope this kind of overview was helpful. If you're interested in learning about different types of business models, you can check out this video right here where we talk through some of the 3 styles of online businesses and kind of give you the foyer into what kind of business you might be interested in starting. So click on this video right here and I'll see you over there.